morning and welcome to your Tuesday, August 20th market news update. The greenback falls victim to Fed policymakers' dovish statements who favor imminent rate reductions post-labor market scare. PBOCs held both of its key lending loan prime rates unchanged earlier today, disappointing those that foresaw easier policy measures. WTI extends losses on rising hopes for an Israel-Hamas ceasefire deal. Natural gas futures jumped 5% after predictions for unusual heat led to higher demand prospects. European traders braced for the bloc's final HICP print for July, the euro on track to hit fresh 8-month highs. US stocks closed their 8th consecutive session in the greens on rate cut optimism. Finally, loony traders zero in on the latest inflation report for Canada. That's all for now, and stay tuned for tomorrow's market update.
Hi, everybody, and welcome to another daily presentation. This is the market overview for the 20th of August of 2024, and these are the key events that you should familiarize yourself before starting your own trading day. Now, the first and sole topic of the day is going to be a small summary of what has happened with the latest PBOC interest rate decision, more specifically about the loan prime rates, the LPRs, earlier in today's Asian session. So the overall theme that was observed was that investors kind of held back and rebuked after this pause from the central bank of China. So earlier today, in today's Asian session, we saw international investors reacting kind of negatively to the PBOC's decision to keep its key lending rates unchanged in the meeting of August, as the move was seen as another small, discouraging hurdle or step in front of those who seek to capitalize upon the forecasted expansion wave of the Chinese economy. So People's Bank of China has abstained from slashing further both its one-year loan prime rate, which is, you can say, calibrated for household and corporate lending, but also its 5-year loan prime rate, which primarily is concerned for the property mortgage kind of holders, and has kept both the LPR rates, the ones we just mentioned, the 1 year and 5 year, still at the 3.35% and 3.85% respectively, in line, however, with broader market expectations there. So, at the end of the day, this was no surprise in the eyes of economists, but also money market forecasters. But at the end of the day, we have some impatient investors that do want to see even looser financial conditions being met or policy decisions being introduced by the Central Bank of China, mainly because we have heard earlier last month at the third plenum that the authorities are indeed looking to fix this kind of stagnating situation for the economic recovery of the red giant, but also the sluggish domestic demand kind of trends by injecting more aid or more liquidity or more help into the markets, not only the stock markets, but also in the FX and the broader domestic scene, in order to revamp kind of the growth tendencies of Chinese economy in order to push it at the forefront of leading global affairs in the financial markets. Okay, so equity traders at the end of the day reacting to this stagnating or this pause from the PBOC. The reaction was unfavorable to say the least. Not that much, but it was not positive. That's something we have to just say point out. It was kind of obvious, and mainly because they have been reacting to this kind of cautious stance, expecting that more looser conditions are going to follow, and this, uh, yeah, kind of pushed them away from allocating more funds into stock markets, and we saw the China 50 index, more specifically its components, its equity components that comprise this kind of index, falling into negative territory, plunging into the reds, and intercepting a 3 day long kind of rally. Not that much, but still. And we also saw the yuan falling on the back of the decision as well. This was kind of paradoxical, we may say, reflecting investors' disapproval. And the main reason, because it's from our point of view paradoxical, is because we have seen these weeks long or months long perpetuated dollar weakness, which was not able, the yuan was not able to capitalize upon. And this decision by the PBOC turned the tide on the opposite direction. And obviously, this kind of dollar long, this months long or weeks long dollar weakness is stemming from money markets' aggressive projections for rate cuts or rate reductions by the Federal Reserve, which has been the theme of conversation for the past few weeks now. So yeah, at the end of the day, we must highlight that yes, trading activity of the Chinese economy is well underperforming. Excuse me, well overperforming its peers on the international scene, mainly the United States and Europe and many other nations and Japan. However, that is pushed to the side for some reason. Also, Chinese growth and industrial production and manufacturing capabilities are indeed performing much, much, much better, for example, compared to Germany and Europe. And some may say better than the United States. And those are, again, those positive signs. And GDP is also outperforming, excuse me, its peers on the international scene. But those three reasons I just mentioned right now are being pushed to the side. And for some reason, investors are approaching this situation with intense scrutiny, the situation in China with much scrutiny in regards to their recovery progress. For some reason, they heavily rely on this kind of aspect of things. And they indeed remain reluctant at dipping their toes further into a market that is, for the right reasons, they are abstaining from this, is because this market is troubled by an atrophying or a detrimental kind of property sector. This is no secret, okay, that the Chinese economy has been plagued by this situation with the property sector. We also see indeed anemic domestic consumption and demand internally, okay, within the borders of the Chinese economy, which is certainly a problem. Also, we see deflationary kind of trends remaining in the Chinese economy, also waning fixed investments and a struggling stock markets. Those are the reasons why we see this kind of pessimism, not extreme pessimism, but at least kind of reluctance at going full force with China. So maybe if additional measures are going to be introduced by the PBOC or the authorities or the finance ministry in order to target and adjust accordingly these kind of obvious problems that the Chinese economy is having, maybe these are going to be good enough signals for international investors to start putting money in and okay, prop up the performance of your stock of Chinese stock markets. Okay, again, for that day, there's not much else to say from this. We will see what incoming data is gonna, what kind of picture it's gonna draw. So for the time being, we're gonna leave it here, and we're gonna thank you for watching, guys, and hopefully we're gonna catch you on to tomorrow's session for another hopefully brief update. For the time being, take care. Bye-bye. Hello. Hi, everybody. Give me 1 second, please. Welcome, guys. Please give me a few moments to calibrate my settings here. Okay, the slides work nicely. Guys, please, can you let me know in the chat whether you can hear me loud and clear? That would be nice. And whether you can see the first slide of the presentation. I think everything is set up and running correctly. Please just give me a thumbs up and we will be on our way. Okay. 103, perfect. Okay, I see people joining in. That's very nice. Welcome, guys, welcome. Let me enable for you to, in a sense, communicate with me via the chat. Okay, I think it's okay. Thanks for the thumbs up. Okay, so welcome, guys. I see Elizabeth, Matthew, I see Elias, Stephen. I'm gonna butcher the name, Velai Kanan. I'm not sure whether that is your first name or your last name, man. Apologies in advance. So I see Roger as well. Welcome. Okay, so we are a few of us here and people are still rolling in. Let's allow a few more minutes and we'll be on our way. Okay, so just a brief announcement. That's going to be announcement, but still. Today we're going to be talking about technical indicators. So we're going to verge on the journey of technical analysis for yet another session. And last time I mistakenly given you a heads up, give me 1 second, that we will be going into fundamental analysis in this kind of session. Unfortunately, that is next week. Okay. So I don't know if I disappointed someone still. Today, we're going to do technical analysis, technical indicators. They're going to be brief. They're going to be basic. They're going to be super simple. It's going to be a brief introduction into the, in my opinion, the three most widely used ones, but also the most easily digestible kind of technical indicators that you can add on your
charts in order for you to get more kind of information and have much more sophisticated kind of approach towards trading. Okay, so thing to remember is that technical indicators are secondary in nature, okay, when it comes to technical analysis. Okay, the first and much more, let's just say, severe or important aspect of technical analysis are the stuff we have covered in the past. So, for example, drawing simple trend lines, support and resistance levels, identifying the major trend and all that kind of stuff. Okay, so charting analysis in a sense, and the mechanical aspect of the analysis of technical analysis comes in the forms of various different technical indicators. Again, the most important aspect is price action, volume, and open interest. Today, we're going to delve into the different techniques, if you would like, all the different other indications that you can add on to your trading regime, okay, that can help you make much more informed kind of, take much more informed actions, okay, or place much more sophisticated trades with a high degree of probability of making money, okay? So enough of me about blubbering about this stuff. Let's get into the topic, okay? Still people joining in. Welcome, guys. So this is a quick risk warning and a disclaimer. You can read that at your own time. I'm not going to go over it. So without further ado, let's visit the first slide, which is, in a sense, an overview of what we will go over in this kind of session. Okay, so this is the agenda. We're going to do a brief intro into technical indicators. We're going to visit moving averages, Bollinger Band's relative strength indicator, so RSI. And at the end of the day, we're going to, in a sense, decompose all of these three, okay, most widely known ones, technical indicators you can add onto your charts, okay, interpret them and understand what information are they conveying, okay. Spoiler alert, these are not used to predict the future. They are not giving you kind of any sort of future predicting kind of, they don't have future predicting kind of powers, okay. They're there in order for you to confirm your own kind of assessment if you have done correctly the charting analysis beforehand, okay? So they are there for a completely different reason, okay? They're not there to give you indication where the market is going to go towards next. Most of them are trend following indicators. They're not forward looking, okay? So don't expect them to be some sort of breakthrough in regards to guessing where the market is going to move towards next. It's merely for confirmation where the market is going. Okay, so introduction to technical indicators, the first topic. So technical indicators, from my point of view, fall under the category of mechanical analysis. Okay, the first one was charting analysis. Again, this is my own personal bias. I like to split it into two categories because it's much more easier for you to understand. Okay, the point is we're not gonna burden ourselves with figuring out which one is the correct category and all that kind of stuff. I merely split it into two sections in order for you to have much more easier and much more comprehensive kind of look out on this kind of stuff. Okay, so technical indicators fall under the bracket of mechanical analysis. So mechanical analysis, in a sense, is performed by the use of these aforementioned indicators. Moving averages are oscillators, envelopes and bands, and many other technical indicators. And the aim of the technician is to establish market sentiment by the help of all these pre-mentioned tools. Okay, so technical analysts or chartists, okay, look for technical indicators in historical asset price data to judge entry and exit points. That's why we use these kind of tools, okay? So these, there are several technical broadly into two main categories. We call them overlays, and the other one is oscillators, okay? Fear not, we're gonna see which is which. So technical indicators are also known as technicals and are focused on trading data, the primary inputs, which is price, volume, and open interest. And technical indicators are commonly used by active traders, okay, since they are designed to analyze short-term price movements, but also long-term traders or medium-term traders can also benefit from all these technical indications for the same reasons by using them in order to spot lovely entry and exit points. resistance. Okay, so irrespective of what type of trader you are, whether you're going to be a scalper, okay, so primarily being fixated upon small price movements within a smaller time frame, whether you will be whether you are a swing trader that takes things in a much more longer term kind of perspective, so capitalizing upon the swings within a specific movement within of a specific instrument, okay, capitalizing upon that. No matter what kind of trader you are, you can use these tools for confirmation. Okay, so identifying potential entry and exit points. Okay, that's why we use technical indicators. So, in a sense, you see the breakdown on the right-hand side corner of your screen. You have technical analysis, the two broad categories, generic categories. Again, this is where the whole my kind of philosophy comes from. Okay, split into two. That's what I meant before. So you have on charting analysis, excuse me, you use bar charts or candlestick charts, whatever that is. You use trend lines. You have, in a sense, to gauge the direction of the market. Okay, so you use channels as well if there are any. Okay, you plot onto your significant pivot points that may turn to be either a support or a resistance level. Okay, and you plot that on your chart in order for you to, you know what, keep an eye on this kind of area, because we have seen a little volume there, and once the price action rose to that level, it couldn't break past that. That means there is a strong or a big wall of sellers there. Okay, that's why you see these kind of sharp peaks on or troughs or bottoms on any given chart, because of the orders that are piled in there. People are expecting to enter the market at that point in time, and they do not allow the price action to rise or fall within that level. That's why you outline it. That's why you draw support and resistance levels, in order to keep an eye on where the price action might move towards to next, and find either support or resistance depending on the situation. Okay, so this falls under charting analysis. Also under charting analysis, you can inspect charts and come up with what we call chart patterns. If you go back to the previous kind of webinars, we went over the most widely known ones, or the most easily identifiable kind of trends, patterns. For example, you can easily spot on a chart a triple top or a double top or a double bottom, all that kind of stuff. Not support and resistance. What we call the cap and handle formation. For example, the head and shoulders, the inverted head and shoulders. We covered that in the past, so you can go ahead and watch that to refresh your memory if you like. But still, those are stuff that those are methods, those are tools that you use onto your chart. So you plot that on top of price action in order for you to get an understanding of where things are going. Okay, that is charting analysis. So mechanical analysis uses the technical indications, which are the ones we're going to discuss today, 3 of them, of the many that are out there. Okay, and are, in a sense, again, oscillators. They are moving averages, envelope and bands, and many others. Okay, so main distinction between the two, you can split that mechanical analysis category into another 2 branches, if you would like. We call them overlays, the ones that go on top of the price action, so near or above the plotted trend lines you have on your chart. Or you have oscillators, which are found not on top of price action, but below. You have a different panel below that. If you, for example, add onto your charts the RSI indicator, you're going to find it on the bottom of the chart, not on top of your chart. Moving average, convergence, divergence, that's another one that goes down there. Stochastic oscillator also goes down there, CCI, etc. Okay, so let me see. This is what I've just outlined. Never mind. So mechanical analysis broken down into another 2 kind of categories. So on chart, you have moving averages, Bollinger Bands, the star, the asterisk near the word indicates that those are the stuff that we will be discussing today. So moving averages, Bollinger Bands, Ichimoku cloud, parabolic saw, Fibonacci, all these kind of technical indicators go on top of price action, so on chart. And the other distinction is off chart indicators, which are, for example, RSI, MACD, ADX, momentum, and many other, McClellan. You can find all that kind of stuff on the off chart. Okay, so this again is a is for you to understand where things are going. We have not delved into how they are actually working. We just outline where you can find them. Okay. So moving averages, making a start with moving averages. If not the most widely used technical indicator tool that is out there, is definitely one of the top two or the top three. Nearly each and every one of traders that I have came across, they are all using moving averages because they're super simple to use, and they give you that visual confirmation, for example, that the market is moving towards downside or upside or whatever that is. Okay. So in a sense, moving average is excuse me, one of the most widely used technical indicator out there. Identifies if a new trend has begun or if an old trend has ended or in some cases reversed. Okay. Plain and simple, this is what moving averages are used for, to spot whether the direction of the market is heading to that specific whether upside or downside, or whether we have seen or we have observed a shift in the trend. Okay, these are this is the usefulness of moving averages. Okay, so it tracks in a sense the progress of a trend. That's it. No, it does not give you an indication, an early indication where the market is going to move towards to next. You're going to understand what I mean soon. It merely gives you a confirmation that the market is moving to the direction, okay? Because it's a trend following indicator, okay? So it is, in a sense, the moving average, obviously, as the name suggests, an average for a certain body of data, and that data is obviously price, okay? So, for example, if you have a 10-day average of closing prices, you have a moving average of 10 days. Okay. Again, super simple. The closing prices of the last 10 days are all added up together. Okay. And they are divided by 10. That's how you get an average. You have an X, an N amount of days, add them all together, sum them up, and divide them by 10. And when we talk about 10 days, and the value of 10 days is essentially the closing price, okay, of each and every subsequent 10-day period that we have beforehand. Okay, so you add the closing prices, the last 10 prices in this example, add the prices all together and divide them by 10. That's in a sense what the moving average is. Okay, so it adds on a new day. Okay, as we progress through time, you add on a new day, the latest day you have, and you subtract, okay, the first day that you used in the past. Okay, so it's a moving average. That's why this is in a sense a technical definition of it. Okay, so your data set moves along with time, and it adjusts accordingly using the closing prices of each and every day within that studied period. Okay, adds all the values together, divides them by 10, and in this kind of case 10, and you get a specific number, okay, which is the moving average of that specific period, that day. Okay, so the body of data to be average moves forward with each and new day, and hence the term moving. Obviously, if you add on the latest day, for example, yesterday, you have to exclude from the calculation the quote unquote 11th day, okay, the first day of your sample size. Okay, never mind about the technical calculations and all that kind of stuff. This is automatically calculated via your platform. Okay, if you set up a moving average of 10 periods, or whether it's 50 or 100, doesn't matter. The software calculates it for you. You will not have to do this manually. Okay, so that is for you to understand how the whole thing is calculated. And by understanding how it is calculated, you can spot, okay, you can highlight what is its strength and what is its weakness, because it has both strength and weaknesses when you use moving average. That is the purpose why we decompose these kind of indicators, okay, to spot the strengths and the weakness and adjust our course accordingly, knowingly that, you know what, this is not a future predicting kind of tool. We act in a certain way, and you will understand what I mean as we progress through this webinar. Okay, so by averaging the price data, a smoother line is produced, making it much easier to view the underlying trend. So a short-term moving average with hug, okay, the price action much more closely than a longer-term one. Obviously, again, I'm saying obviously way too much, but it's super, super obvious. So the greater the number of time periods used, the greater the smoothing. So if you see on the right-hand side corner, on the right-hand side of the slide of the presentation, the moving average that is closest to the price action is obviously the smaller one, and the long as you add on extra, okay, periods in the sample size. So if you go from the 10-day moving average and you add instead of 10, you adjust that to 50, you get a much more smoother line, which is further away from price action, okay? So same goes for if you go from 10 to 50 to 200, you can see the line is way out of the price action. It does not hug the price action as closely as the short-term one, but at the end of the day, it gives you a confirmation that in this kind of case, the price action is moving to the downside, okay? So again, it's for visual illustrations only, okay? It confirms your own assessment that the price action is moving to lower ground. You can clearly see that from, without the price action, you can tell straight away that the price action in this kind of scenario goes to the downside. Moving average confirms that. That's it, okay? So we're gonna see how you can use the moving average to your own benefit, okay? You will see. So there are 3 types of moving averages, okay? What we call the simple moving average, the linearly weighted moving average, and the exponentially smooth moving average. No need to go into much more detail. Most traders use either the SMA or the EMA, so the exponential or the simple one. They have some sort of small differences, okay, in regards to the calculation. For example, the exponentially smooth moving average, it uses much more weight on the recent, okay, price fluctuation or the recent price closures, okay, compared to the early one. For example, if you have 10 periods, okay, a moving average, an exponential moving average, a simple moving average of 10 periods, okay, you add all those values together and you divide that by the number of the moving average, the 10, okay? So all the values have equal weights. What the exponential moving average does, in a sense, the EMA, is you have the same amount of periods, 10 periods, and you have 1, 2, 3, 4, 5, and it goes until 10. It gives much more weight on the 10, 8, the 10, 9, and 8 values, the closing prices, the most recent ones, compared to the ones that you have at the start, the 1, 2, 3. Okay, this is what it does. So by using this kind of EMA, you have much more accurate, quote unquote, tracking of the trend, okay, by using this kind of small modification of a moving average. But at the end of the day, they do exactly the same thing. They are a trend following indicator that gives you confirmation whether the price action is moving to a specific direction, either up or down or sideways. Okay, that's it. Okay, so excuse me. So I've spoiled this quite a few times so far. I'm going to do it once again. The moving average is a follower, okay? It's not a leader. It does not give you forward-looking kind of guidance, okay? It follows the market and signals that a trend has begun, but only after that has happened, okay? So the price dictates the values of the moving average, obviously. Okay. So again, that's why we use them as a secondary tool, not a primary. Okay. That's why technical indicators come second to the charting analysis or the price action analysis. Okay. Because they are a trend following indicator. They're summing up the values that have occurred in the past. Okay. Make that clear. Keep that on the back of your mind. That's a weakness, and we can exploit that weakness by using different stuff in order to hedge, if you would like, our bets. Okay, you'll see what I mean. So strategies by using moving averages, there are plenty of them out there. I've outlined 2 and the most simple ones. Okay, so by using one moving average, when you have the market closing above the moving average, okay, this is what we call a bullish signal. So whenever you have price action and you plot a moving average of 10 periods and you see the price action, okay, breaking above that line, above that moving average, this is a very simplistic way of going at trading, okay, at opening positions. But in traditional kind of strategic, how would you call it? When this was used, when this kind of moving average theory came out, that you can exploit it by giving these, when it gives you these kind of signals, this is a very simplistic way of doing it. Once you saw a break above that moving average line, that generated, in a sense, a bullish signal. So therefore, you are bought there, expecting the price action to move to higher ground, because it signals that a trend, an early trend, that the trend has indeed shifted and moves to a different direction. And when you see on the flip side a price action, okay, a closing day or closing of a day below that moving average line, you would get a sell signal. Okay, super simple, but also way too risky if you want to use this kind of strategy to make money. Okay, so a much more appropriate, okay, and a little bit more sophisticated kind of attempt at using moving average in order to comprise a sort of strategy is by using two moving averages. Okay, pretty much the same kind of rationale applies here as well. So you have in a sense two moving averages. You have one that is deemed definitely a small one, and one and the other one is going to be a long one. What I mean by small and long, for example, the only thing you can calibrate is obviously the periods. So when you have a short-term moving average, for example, it might be for 12 days. Okay, so the studied period, the sample size is 12 days, 12 past closing prices, the average of that. And the long one might be, I don't know, for example, something like 26 or 50. Okay, so you have a difference between the studied period. So you have a small moving average and a long moving average. So in a sense, you adjust the parameters accordingly. So in a sense, what you are doing with this two moving average kind of strategy is when you see the small moving average, okay, for example, the 12 period, okay, crossing that line, crossing below, in this kind of case, let's cross it above the long-term moving average, the 26 period or 50 or whatever that is, okay, that would generate, okay, a signal for a buy, okay? So on the flip side, when you have the small moving average, the 12 period line, okay, crossing below, okay, the long-term moving average, this creates, in a sense, a bearish signal. So therefore, a short position is undertaken. So please allow me to switch slides and you will see visually what I mean, okay? So you have here, in a sense, the green line, and you can extrapolate which one is the short one and which one is the long one. If you remember the first, no rule, but the first observation we have made in the past, 3 or 4 slides. So when you have a moving average by visual inspection, the one that is closest to the price action is compared to the one that's further away from the price action. The one that is closer is obviously the short one. The one that is longer is obviously the long-term one. Okay, so in this kind of case, the green line, okay, you can see that it hugs much more closely the price action compared to the blue line, is the small moving average, whereas the blue line is the long-term moving average. So remember, once we said, when we said that whenever you see the green line, can you see my pointer? Hopefully, let me. Once you see the green line, okay, crossing below the blue line, okay, this generates what we call a bearish cross, or in other words, you can hear this kind of terminology in markets, the death cross, okay, the death cross, okay, again, generates a sell signal, okay. Pardon my shaky handwriting, my skills are bad, obviously, you can tell. Okay, so whenever you see the green line or the short-term moving average crossing below the long-term moving average, generates a bearish cross, and you can clearly see from there onwards, price action move to lower ground. because we have spotted with using the two moving averages shifts, okay, in the trend. Okay, this is why you use the moving averages to identify clearly whenever you have a crossover between these two lines that the price action has the move of the market has indeed shifted. Okay, either temporarily or either in other kind of situations in a much more radical way, and you will see in this example. So short-term moving average below long-term moving average, sell signal. Whenever you have the short-term moving average, the green line crossing above the blue line, you create a buy signal. And in this kind of case, remember, look at this, not that kind of reliable, okay? Yes, the price action has moved to higher ground. Yes, it has breached, but not that much potential upside. I mean, relatively speaking, not that much, but if you zoom in that kind of period, you could have definitely made money on this, okay? So whenever you see the small line crossing above the long one, okay, the short-term moving average crossing above the long-term moving average, we call this a bullish cross, or in other words, a golden, okay, cross. Gold coming out of the precious metal. And bearish cross is called death, okay? Death cross, golden cross, etc. Okay, so in a sense, when you hear someone say, "Oh, I've seen a golden cross being formed on a WTI chart, on a 4-hour WTI chart," we know exactly what he means, or he or she means. Okay, so you see that the short-term moving average has crossed above the long-term moving average. Okay, so generates a buy signal. Okay, so buy. Yeah, yikes. Okay, so buy signal. Flip side, same kind of case comes here as well. Green line, short-term moving average crossing below the long-term moving average. The blue line generates a sell signal. But in this kind of case, if I'm not mistaken, this is what dollar yen daily chart from the past, definitely from the way past. Once again, after a nice consolidation near this kind of level, okay, you see that the shift in the direction and the confirmation by the moving averages. Okay, so green line, short-term moving average crossing above long-term moving average, okay, generated a bullish cross, so a buy signal there, and you have a definitive long signal here. Okay, so after you get the confirmation or the crossover of the two lines, there is a lot of other items on your checklist before you go blindly into a trade. We're going to use that methodology, that two moving average strategy into the future. Okay, in future webinars, and you will see what I mean. We're gonna add on many other stuff, many other different indicators, because if you just blindly or solely base your trading strategy on only using this, I'm afraid to say that the odds of succeeding are not that high. Why not add more stuff to your chart, more do a much more undertake a much more sophisticated approach and have a higher degree of probability of making a correct trade, okay, with not much hassle. Okay, for example, placing support and resistance levels, awaiting for a key breakaway from a clear resistance level. Okay, you can have much more informed or much more sophisticated trading strategy or journey if you undertake many other stuff to your assessment from the beginning. Okay, so but crudely looking at things, whenever you have crossovers, this is what generates the buy and sell signals respectively. Okay, for the final time, when you see the short-term moving average crossing below the long-term moving average, that's a sell signal. Whenever you see the short-term moving average crossing above the long-term moving average, that generates a buy signal. That is all in a nutshell for you. That's all you need to remember when it comes to two moving average strategy, or a strategy that uses two moving averages. Okay, hopefully I didn't confuse you. So moving on to the next one, okay, which is going to be Bollinger Bands. See you later. Okay, so Bollinger Bands are obviously another technical indicator that is most widely used one in trading circles, if you would like. Okay, so this technique was in a sense developed by a guy named John Bollinger, hence indicator of Bollinger Bands. The guy created it, branded the name. Okay, so two bands are placed around a 20-day moving average. Okay, so we're using a moving average, but not in the same way that we have discussed in the previous slide. Okay, remember the concept of moving averages, closing of a specific period, the closing prices of an X amount of period. Okay, so for example, in this kind of case, 20 days, add them all together, divide them by the number, which is 20, and you get that value. Okay, this is exactly the same philosophy, but we're not primarily concerned with the moving average in this kind of case. This is a one component of moving average. Okay, so you'll understand. So Bollinger bands, obviously you can tell from the name, when we talk about bands, we're going to have some bounds that are going to be placed around the price action. Okay, so this is the element of the bands, and they come in the form of, you have the 20-day moving average plus 2 standard deviations for an upper band, and a 20-day moving average minus 2 standard deviations for a lower band. Okay, yikes. Okay, this is the moving average line in the middle. So, and for example, this is the price action. Okay, so if you plot a Bollinger Band on your chart, you're going to see that it goes up on top of price action first and foremost, and you have, in a sense, a guided kind of threshold, okay, that goes on the extremes of the price action, either above or and above and below. Okay, so it's a sort of a cloud that goes around the price action, and you will see what kind of implications does that have. Okay, so 2 standard deviations. If you have not any background in statistics or mathematics, fear not, is not something, is not a crazy or a much more or a complicated kind of topic. You will see here what I mean. So standard deviations is a standard deviation is a statistical concept that describes how prices are spread around an average value. So this is the definition of standard deviation, okay, in statistics. So in trading, you take that kind of concept, the standard deviation, and you have, in a sense, an average value, okay, which is what the role that is played by the 20-day moving average in this kind of case. And 2 standard deviations are, in a sense, the buffer zone between the moving average and the most extreme kind of level. And also the moving average, the lower bound is, in a sense, the moving average minus that 2 standard deviation. In a sense, standard deviations are indeed measuring the spread or the difference or the fluctuation of price around the medium value, the average value, much more specifically. But the thing you need to remember is that by using 2 standard deviations, by creating this kind of buffer zone around the price action, in a sense, you are placing a fixed, not fixed, by a dynamic kind of band around price action, which attempts, this is the important part, which attempts to capture, okay, at least the 95% of price action. So we're talking about the bands are used to capture extreme volatile moves that do not, okay, go with the norm, if you like, in simple words. So the 2 standard deviations are, in a sense, capturing the possibility of the price action moving in an erratic way, okay, and captures the 95% of the time of that volatile price action. It's built into the price by using that moving average line. So in a sense, what we care about is that remaining 5%, okay? So if the bands are capturing the 95% of volatile price action, compare that with the moving average. Why? The reason why we use the Bollinger Band, in a sense, is to capture that remaining 5% that goes above the price, the bounds, and you will see what I mean by this example. So, for example, here, this is the moving average. In this kind of case, the 20-day moving average. Okay, much like this moving average. Okay, the simple 20-day, 20-period moving average. Okay, this is the midline of the Bollinger Band. This is the upper bound of the Bollinger Band, this line down there, okay? You can clearly see here, and this is the lower band. Remember, the two standard deviations capture the 95% of volatile price action, okay? So we are, and you can clearly see that 95 most of the time, or 95% of the time, you see the price action being within the two bounds, okay? So the price action, the Bollinger Bands capture the 95% of volatile price action, and you can clearly see that with the Bollinger Bands. What we care about in this kind of case, by limiting our kind of narrowing our point of view, is that we are looking for the breaks, okay, above and below the Bollinger Bands, which in a sense are telling you that, you know what, this movement is way too excessive, okay? It's that 5% chance of a move going at an extremely volatile kind of range, which is not contained within the Bollinger Bands. So we care about the remaining 5%, and we use that information accordingly. So for example, if you see a break above the upper bound of the Bollinger Band, signals a definitive excess volatile move, and taking into consideration one of the key principles of trading, or in many things in life in general. So more specifically in quantifiable kind of subjects, okay? Quantitative, excuse me. Whenever you have extreme volatiles away from the mean, afterwards you tend to get what we call a reversion towards it, okay? So when you have erratic price movements after a specific period of time, prices once again tend to come close together and revert what we call back towards the mean. It's an unwritten kind of rule, much like an observation from traders within financial markets, that when you have these kind of excessive moves, after a small period of time, small depending on the situation, obviously, you tend to have what we call a reversion towards the mean. And this is a perfect example. Once you see the price action after volatilely swinging away from the midline, okay, they come once again together and form what we call consolidation areas. I'm not going to attempt that. Never mind. Okay. So in a sense, we care about the 5%. So the extreme volatile moves that go above or below the upper or lower bound of the Bollinger Bands. And when we see the price action breaking above it, okay, then we extrapolate, okay, sometimes rightfully so, sometimes wrongfully so, that the price action will indeed revert towards the mean. Okay. This is an unwritten rule, but it has, from an observational standpoint of view, has worked many times in financial markets. So this is what you're trying to capitalize upon. That 5%, if you see the break above it, you would extrapolate that the price action will once again come within bounds, okay? And then once again normalize or attempt to consolidate near the midline, which is the moving average. And you can see here, after this volatile kind of move, a sell signal was generated. Okay. After the break above it, you see the price action coming sharply within bounds. Once again, you have a sell signal here. Okay. Extrapolating that is going to come back towards the consolidation area. Does not happen. It violently swings to the other direction. Okay. Comes down here, breaks below the lower bound of the Bollinger Band, which generates a buy signal. Okay. And by blindly using solely using Bollinger Bands, if you have actually placed a short order here, okay, you would have actually made money, okay, if and only if you have been paying attention, obviously, to the price action, okay. There's plenty of ways of playing this, okay. And on the flip side, if you have been ascribed by this kind of technique, by buying whenever you have breaks below the Bollinger Bands, okay, you would have made marginal kind of gains. And the reason why for this is because we have, in this kind of case, we have not taken under consideration the primary direction of the market. Okay, primary direction of the market of this specific instrument, which is dollar yen, is obviously towards the downside. You don't need a moving average to tell you that. You can see that clearly from the price action. Okay, so you, in this kind of case, you would have been biased, or your opinion would have been skewed in favor of selling this kind of instrument because it moves to lower ground rather than buying. Okay, so buying it is for covering or your position in the sense of this. And whenever you go to expect, you would have expected a rebound from the break below the lower bound of the Bollinger Bands. You would, if you have made this assessment, you wouldn't have expected to get a sharp rebound up then. Okay, because the primary direction of the market is downwards, so we're skewed towards the selling side here. Okay, so we expect to get much more profitable trades by selling this kind of thing rather than buying the dips. Okay, so something else you have to keep on the back of your mind as well. Okay, so let me finish up. Hopefully this visual illustration has helped you understand how and why we use the Bollinger Bands and how it is made. Let me finish up this kind of definition here, and we'll be once again back on that chart. Okay, so Bollinger Bands measure the volatility of the instrument under study. So when the market becomes more volatile, you tend to see bounds or the bands widening. Okay, case in point. Okay, this extreme move above it, look up where, let me move to a different example because that is not that well. Okay, so you see the break below it, you see this band kind of widening. And when you have areas of consolidation or periods of low volatility, you tend to see the Bollinger Bands coming much close together. Okay, so they adjust accordingly, they adjust dynamically around the price action. Okay, depending on the situation. If you have high volatility, bands widen to capture that 95% of excess and volatile moves. Whereas when you have some sort of agreement between buyers and sellers, and then you have these kind of areas of consolidation or the formation of a trading range, you tend to see Bollinger Bands narrowing, okay, becoming much more fitted nicely around the price action. Again, indication that there's some sort of consolidation taking place at that kind of level. Okay, hopefully that's easily understood. Okay, so the wider the volatility, the larger the bands; the lower the volatility, the narrower the bands. Okay, again, unwritten rule you should keep on the back of your mind. Okay, so the closer the prices move to the upper band, the more overbought the market is. And this is, generally speaking, a kind of subjective assignment of importance. Okay, but still, yeah, it has some sort of truth behind it. Okay, so when you have excess kind of volatile moves, obviously in this kind of case, the bulls were eager to push the price action to higher ground in a much more volatile kind of manner. Okay, that in a sense gives you an indication that there may be some sort of overbought conditions there. And once you see the break above the Bollinger Bands and you see the start of the reversal, that gives you an indication that the bears have indeed spotted that volatile move, that overbuying, that exuberant kind of mentality from the buyers, and they are actually entering the picture to push the price action to lower ground. Okay, that's how the whole dynamic comes into fruition. Okay, so the bulls are tagging this kind of rope way too harshly. Okay, and the bears are responding by pulling back as well. So if you can imagine that as a game of tug of war between where is going to be the correct price action. Okay, so once you have bulls dragging the rope way too much, you're going to see at the same time some overreaction from the other side as well, tagging back. Okay, or because it's another lovely place for them to place a short order and capitalize on the downside. Okay, so you can extrapolate from these kind of moves that whenever you see a break above the upper Bollinger Band, that is an overbought kind of condition behind the move. Okay, and when you see the price action breaking below the lower band, that means there is an oversell kind of mentality again behind the move, and you would expect the opposite reaction to take place. For example, if you are in oversold kind of conditions, okay, that means that the bears are actually gaining a lot of momentum, and the bulls are starting to enter the picture to equalize their strength, okay? Their, neutralize their reign, if you would like. So they start piling in buy orders in order to correct this kind of over exuberant or this excessive kind of move, this volatile move. They, in a sense, abide by the quote unquote law, which is not a law, it's an observation that the mean, the price action tends to revert towards the mean after some volatile move. Okay. So the closer the prices move towards the lower band, the more oversold the market is. Yes, this is what we just said. So upper and lower bands can be used as price targets. Something that we have not discussed, okay? And let's go on to this example, for example, right here, okay? You see price action breaking briefly, but not closing, okay? Outside the Bollinger Bands creates a buy signal. Okay, so it creates a buy signal here. For example, if you go ahead and use this strategy as useful, okay, use it with a purpose of entering and exiting the position and making money. So in a sense, the traditional way of going at this is when you have a generated kind of buy signal, when you see the breakdown below the Bollinger Band, the lower band of the Bollinger Band, you enter the position there and you aim for the midline for exiting the position. Again, abiding by the rule of, again, quote unquote rule that the mean, the prices tends to revert towards the mean. Okay. So you buy there and you exit the position here. Some other modifications of this kind of strategy might be you buy whenever you get a break below the lower band of the Bollinger Band and you have a target at the upper limit of the Bollinger Band. Okay, so holding the position up until there, if and only if it comes. Sometimes it might not come, and price action might revert to lower ground, and you can leave, in a sense, a lot of money on the table and not make as much as that. So it's a flawed way of going at trading solely by using Bollinger Bands. You can obviously use this, but it's beneficial, once again, to use many other technical indications and many other charting techniques in order to validate your view. Okay. So, okay. Traditional way of going at things is, again, as I just mentioned, sell whenever you see the price action nearing or breaking briefly above the upper bound of the Bollinger Band. That was an extreme scenario, this one here. Okay. Selling to the top and aiming for the midline, or once again, a break on the opposite, on the other bound for covering your position. Okay. So you buy there, you sell there, okay, covering your position. You short at the top, okay, and you cover your position here. Okay. Obviously, you could have exited position with some nice profits, but looking at this afterwards, you would have blamed yourself of why have I not kept my position open and all that kind of stuff. Again, because we're missing the point, we forget that the main direction of the trend is towards the downside, and you have much more, and at least you have the odds in your favor that the move towards the downside is going to have much more potential compared to the move towards the opposite direction. Okay, so that's what I said in the beginning. We're primarily skewed for selling this specific instrument rather than buying the dips. Okay, so selling it, it's much more in your favor. Okay, and if you, for example, have plotted a lovely straight line, a descending trend line from the tops, okay, this is one top, this is another top, okay, another top, okay. If you see the price action moving closer to this kind of descending trend line and failing to break above it, so it didn't do this, okay, it just reverted sharply towards the lower side, okay, you would have been skewed primarily on the sell side, and you would have had in the back of your mind, you know what, I can let this go a little bit more further compared to, on the flip side, this kind of trade, in which you would have been primarily much more cautious because you go against the market. And a rule to remember is that for the ease of mind and for psychological health being, if you like, just please trade with the trend rather than trying to go against it. At least in the early stages of your trading journey, it's much more wiser to identify the main direction of the trend and trade with it and not against it. Okay. Trading against the trend is a little bit much more complicated. Obviously, it needs a little bit more skill, which you can master once you put in the effort and the work, and obviously understand how to spot much more nicely the opportunities. Still, in much more riskier compared to trading with the direction of the market. So in this kind of case, that's why I mentioned many times, if you have made the assessment that the market is moving to the downside, primarily your assessment would have been skewed or biased towards selling this rather than buying this. Okay. Yeah. That's something that comes along the way. Okay. So moving on. So I think this is extra interpretation of the Bollinger Bands. Let's go over it, hopefully, if I have not missed anything. Okay. So most of the things we're going to see here are the stuff I just mentioned on the go while we were studying the this slide. Okay. So let's briefly go over it. So Bollinger Bands is a technical analysis tool invented by John Bollinger in the 80s. Okay. Having evolved from a concept of trading bands, predecessor of Bollinger Bands. Okay. The main distinction between Bollinger Bands and trading bands is that Bollinger Bands are much more dynamic. Okay. So they can fluctuate accordingly depending on the volatility of the instrument. Comparing this approach to trading bands, much more simpler way of going at it. Trading bands actually did not use standard deviation as the calculation. You have the moving average, but you had fixed kind of bands, either, for example, 2 or 3% above it and 2 and 3% below it. Okay. So it's a fixed band. It's not a dynamic. It does not adapt accordingly to the price action. Okay. Same kind of rationale with the Bollinger Bands. Right? At least trading band, the Bollinger Bands have the same rationale with trading bands because trading bands are the predecessor of Bollinger Bands. You get the point. But they are not as dynamic as Bollinger Bands, trading bands, meaning. Okay. Trading bands have fixed bounds. Bollinger Bands have dynamic bounds. That's it. Okay. So Bollinger Band can be used to measure the highness or the lowness or extreme kind of moves, either upside or downside, relative to previous trades. So the Bollinger Bands consist of the simple moving average and period. You can pick and choose. We have noted that from empirical studies, the 20 period is the most widely used one and the most studied one that kind of yields the, I don't know, the most appropriate kind of profit targets. Okay. So the upper bound is K times minus an N period standard deviation. Don't overcomplicate things. Standard deviations are 2. You can also increase the standard deviation and make it from 2 to make it 3. So 2 standard deviations capture 95% of the volatile movements. Okay. 3 standard deviations capture the 97% of volatile price movements. So 2 standard deviations, we look for the 5%. 3 standard deviations, you look out for the 3%. So if you expand or if you make the 2 standard deviations 3, the bounds of the Bollinger Bands capture more of those volatile and extreme moves. Okay. So we're left with uneven, much more volatile moves with that remaining 3%. Okay. That's pretty much it. So 2 standard deviations below, 2 standard deviations above the moving average, which is the 20 period. Okay, we covered this. So the default choice for the average is a simple moving average, but you can use obviously exponential or linearly weighted kind of moving averages, irrespective. So exponential moving averages are a common second choice, but is gaining momentum in recent times since the EMA is more sensitive to price movements compared to the simple moving average. This is what we discussed a few slides back when we compare small moving average with the exponential moving average. Okay, exponential moving average gives much more gravity, okay, or at least gives much more weight allocation on the recent X amount of days compared to the simple moving average, which is add them all together and divide them by the number. Okay, that's pretty much it. So usually the same period is used for both the midline band and the calculation of standard deviation. Okay, fair enough. So interpretation, quickly going over it, the use of Bollinger Bands varies widely amongst traders. So some traders buy when the price touches the lower bound of the Bollinger Band, okay, and exit when the price touches the moving average in the center. So this is what we're talking about here. Buy whenever you see the touch down there, sell down here. This is the first scenario. And the second scenario, sell when the price breaks above the upper bound of the Bollinger Band, anticipating the correction, or buy when the price falls below the lower Bollinger Band. And essentially, you let it run in a sense to the other side. So first strategy is buying here, selling here. The second strategy is buying here and selling at the next touch of the price action on the upper bound, on the opposite bound of the Bollinger Band. Okay, so the bands lie close together in a period of low volatility. Yep, what we call consolidation or trading range areas. And when they are far apart, when they widen, that indicates a period of high volatility. Yep, we noted that. So when the bands have only a slight slope and lie approximately parallel for an extended period of time, the price of a stock or whatever instrument that is will be found to oscillate up and down between the bands as through in a channel. This is the channel, okay? So the bounce acts as resistance, the lower one acts as support. So you can buy here, sell here, buy here, okay? That's in a sense, in a nutshell, what a channel is, okay? You don't only trade with a trend, you can also trade the sideways channels as well, okay? By buying at the bottom of the band and selling at the top, selling at the top of the band and buying on the bottom if you have a price action consolidating within a tight range. Okay, super simple, I think, hopefully. So traders often are often inclined to use Bollinger Bands with other indicators. Thank you. So see if there is confirmation. This is what we look for. This is what we are after. Okay, we need confirmation from other technical indicators as well, much like some other non-oscillators. Okay, so in particular, the use of an oscillator like Bollinger Bands, will often be coupled with a non-oscillator like chart patterns or a trend line. Yep, I just mentioned. So if these indicators confirm the recommendation of the Bollinger Bands, the trader will have greater evidence. This is what we're after, confirmation and evidence that the band's forecasts is correct. Okay, so in a sense, what I'm trying to say here is that we are cross-checking our biases, our assessments with many other different tools. We don't use solely moving averages. We don't use solely Bollinger Bands. We don't use solely RSI. We use them all together alongside with chart patterns, with trend lines, with support and resistance levels, and all that kind of stuff. Okay, why not use them if when they are super simple to apply to your chart? We are currently discussing how to plot them on your chart and decode them, okay, easily and with much more comprehension. Why not use them all together to get a much more much higher percent or a much greater probability at making a correct choice? Okay, it's, from my point of view, it's paradoxical. Okay, so please use many of this stuff together in order for you to have a much more sophisticated way of going at things. Okay, a higher degree of probability of making money. Okay, pure and simple. Lastly, we're way past our time, but still give me please 10-15 minutes. How much? We'll see. So we have the last topic for the day. It's going to be RSI. We've done moving averages, we've done Bollinger Bands. Let's go ahead and do RSI. Okay, so RSI, the relative strength index, measures the speed and change of price movements. Okay, usually over an X amount of period of time. Most of the time is use a 14 period. Okay, there is empirical evidence and a theory behind why we use 14 periods. We're not going to go into the nitty-gritty details. Most people use 14 days. You can adjust that accordingly to your liking, okay? But for the time being, traditional view is 14 period, okay? So it ranges, in a sense, RSI, between a value of 0 and 100. This is the scale, okay? Something else, RSI does not go on top of the price action much like the Bollinger Bands and the moving averages we just visited. RSI goes below the price action, okay? So it's in a different panel below your charts, okay? Does not overlap with the price action, okay? Keep that in mind. Therefore, if it's found below, it has what we call the range, 0, 100 extremes, okay? Bottom is the 0, 100 is the top. You cannot have any values going above or below them. Those are the extremest of the extreme levels, and RSI fluctuates between them, okay? So when you use the specific indicator, the RSI, okay, which measures, once again, speed and change of price movements, okay, traders are, in a sense, looking for overbought and oversold conditions, okay? Much like the stochastic oscillator does. Stochastic oscillator we're going to do in the future. Much more applicable, much more nicely used, or at least much more appropriately used in areas where you see sideways price action. Stochastic indicator is nearly perfect when you have consolidation areas where price action is bouncing within 2 bounds, okay? Stochastic oscillator is perfect for that, nearly perfect. Whereas RSI can be applied in many different situations, is much more versatile, and it's much more preferred when the market is trending to either upside or the downside, okay? So, for example, if you have a market moving to the downside or the upside, you can use RSI, and when you have a period or an area of consolidation, okay, or a sideways price action, okay, you use the stochastic instead, okay? So you see how you when you spot the weaknesses of one technical indicator, you take advantage of that by using a different one, okay, that fills in the gap, okay? And you can have this approach no matter what kind of environment it comes at you, okay? That's the whole point. Okay. So going back to RSI, enough of me blabbering. So it ranges between 0 and 100 and alerts traders for overbought and oversold conditions, as the stochastic indicator does, oscillator does. So readings above 70. Okay. So the thresholds are the thresholds are 70 and 30. 0 and 100 are the extremes. So readings above 70 are considered to be overbought. Again, it's not written in stone, okay? You can have, instead of 70, you can have 80, much more extreme situations. And instead of 30, you can have 20. So it's subjective, and you can calibrate that with your own liking, okay, if you would like, okay? You can mix and match and adjust that accordingly. So but the traditional way of reading the RSI indicator, you use the 30 and the 20, the 70 and the 30, as the 70 being the overbought and the 30 as being the oversold, for, again, spotting extreme kind of scenarios, quote unquote extreme scenarios. And you use that information accordingly, much like the Bollinger Bands. You buy when the price action, when the RSI registers an overbought condition, an oversold condition, you buy, and when it registers an oversold condition, you an overbought condition, you sell. When it's oversold, you buy. Okay, sorry if I'm confusing. Okay, you'll see soon. So something else we have to note is that, as we just mentioned, you have 0 and you have 100. The midline or the midpoint is the 50. So if you see RSI values surrounding and fluctuating near the 50, gives you a confirmation that the price action has entered a period of consolidation. Okay. No, not the bulls, nor the bears are in control of the momentum of the move. Okay. Okay. So many use the 50 midpoint to distinguish between bullish and bearish momentum. Okay. So remember, it measures the speed and change of price movements. Some values above the 50 level, between the 50 and the 70. Okay. Gives you an indication that the bulls are in control. Values between the 30 and the 50, so below the midline. Okay. bears are indeed in control. So above 70, over bought conditions, below 30, oversold conditions. Okay, so this is the visual illustration of the RSI below here. Okay, so this is this line, this dotted line here, if you can clearly see it, is the RSI bound of 30. You can see it right here. And this is the 70. Okay, so remember what we said, above the above the 70, we have overbought conditions. So again, you extrapolate the same way, much like the Bollinger Bands, when you have extreme movements above or into overbought kind of consolidated overbought conditions, you tend to expect the reversion towards the mean. That's how you use the RSI as well. But also you use that for confirmation of momentum. So it's not as clear cut as Bollinger Bands. It has some sort of idiosyncratic kind of values, okay, or principles, and we will see them right now. So RSI index, a technical indicator that in the use in technical analysis of financial instruments, so is intended to chart the current and historical strength or weakness of an instrument based on the closing prices of a recent trading period. So similarly to moving average, but it's not that. Okay, exactly. So it gauges how strong or how weak an instrument's price action is. Okay, when we're talking about the current. So the RSI is classified as a momentum oscillator. Okay, it's an adaptation of the initial momentum indicator. Okay, they in a sense added a few more parameters to it and constructed these essentially the ranges, and they constructed the RSI as an indicator. So it measures the velocity and magnitude of directional price movement. Okay, when you have an RSI value soaring, okay, to higher ground, okay, from the 50 goes to the 70, that in a sense gives you the indication that the price action is accelerating. So by X amount of rate of change. Okay, I'm not going to complicate it even further. So momentum, in a sense, is the rate of the rise or fall in prices. So when you have the slope of the RSI line is also crucial. Okay, so the steeper, okay, the move of the RSI indicator gives you an indication that there is super strong momentum. Okay, so the how steep the line is gives you how much strength the move has, and how flat it is gives you an indication that that momentum is being watered down, if you like. Okay, so it's loosening its momentum. It's the rate of change of prices is not evolving as rapidly as, for example, compared to a sharp slope of the RSI. Okay, so the RSI computes momentum as the ratio of higher closes to lower closes. This is the nitty-gritty details of how it's constructed. So you accumulate all the past higher closes, you accumulate the past lower closes, divide that with each other, and you get a ratio. This is the value of the RSI. Okay, so instruments that in a sense have more or stronger positive changes have a higher RSI, okay, than instruments that have more or negative changes. Again, pretty self-explanatory. So the RSI is most typically used for a 14-day time frame. Again, you can adjust that accordingly, measured on a scale from 0 to 100, with high and low levels being marked at the 70 and 30 respectively. Again, you can adjust that to 80 and 20, or in some super extreme cases, 90 and 10. Okay, so you have a scale of 0 to 100, 70 and 30 are the key thresholds. 50 line is the midline or the baseline. Okay, so those are the key levels that you need to digest in regard to understanding and deciphering what the RSI indicator is telling you. But beyond that, you need to take many, many other points under consideration as well. For example, where is primary trend moving towards too. That's clearly one. But secondly, you need to look at RSI not only based on the value, but look at it much like price action as well. So for what I mean by this is that when you see consecutive higher lows, okay, this is one low and this is a higher low, okay, that is definitely a very nice signal that the bulls are eager to push the price action to higher ground. They are eager to push prices with a faster pace going forward. Okay. So the consolidation, okay, and the formation of a new higher low on the RSI indicator, not on the chart, on the RSI indicator, can also be deciphered much like the price action. So in traditional charting, kind of looking at things, approaches, so a higher low is a very nice indication that the price action will continue to move to a low, to high ground. And you do that with a basic trend line. Okay, that's one. It was broken there, but you can draw a different one, much like here. Okay, so by drawing a trend line much like this, gives you an indication where the price action is currently headed towards to, and the rate of how fast it can rise to that direction or fall to that direction, in this kind of cases rise, can also be gauged by the RSI indicator below. Okay, and once you see consecutive higher lows, this is one low, this is a higher low, same level, but still another one is there, you expect the price action, okay, to pretty much accelerate its pace, okay, towards the upside in this kind of case. Remember, once again, this is not a future looking indicator, okay? It merely registers the highs, the amount of higher closes compared to the amount of of lower closes, much like this. This is the ratio. And gives you the RSI value, which again, obviously is a momentum indicator, okay? So the more higher closes you have in the past 14 periods, the higher the RSI number will be, okay? The lower closes compared to the higher closes, the lower the RSI number will be, okay? It gives you the respective kind of value, okay? By the end of the day, let's continue with our example here. RSI indicator, in this kind of case, we see the slope, okay, pointing towards a sharp upside. You see the rise and the rally of price action. Okay. And then you see peak right here. Okay. It breaks above the upper bound, okay, of the 70 bound, and enters overbought conditions. Therefore, from there onwards, you would reasonably expect to get some sort of pullback. Okay. So an easing of this kind of volatile move on the opposite direction, and you would expect some sort of consolidation to take place. In a sense, you would expect the market to catch what we call a breather. Okay, so after running for quite a substantial period of time, a breather, a breath must be undertaken, because it cannot keep going upwards for eternity. Okay. So you have what we call in markets zig and zag moves. Obviously, you can see here. Okay. So that's why you extrapolate that the price action will, once it breaks above the upper bound of the RSI, the 70, and enter overbought conditions, some sort of retracement will take place. It has taken place, but okay, not for long. You see 1, 2, 3, and you see the RSI registering and managing to form a higher low above the midpoint. So remember, values above 50 and between 70, okay, are still bullish. So in this kind of case, values were below the midline, the 50, okay, the midpoint, which meant bears are in control. And you can clearly see, okay, some slide, okay. After we see the break above the midline and the soaring of the RSI indicator, after lovely streak of rises by prices, you see reaching overbought conditions, and then you see a pullback, but you see a consolidation taking place between the 50 and the 70, which gives you an indication that the bulls are still in control. Yes, they are pushing prices to high ground, not at the same pace as they have been beforehand, but still they are in control. So you maintain, in a sense, your bullish bias in regards to this. And once you see the RSI indicator, once again with price action, confirming you the move upwards and the rise once again towards the 70, okay, you have faith in your assessment that the price action will continue to move to higher ground. For example, looking at it from a super simplistic point of view, let's assume that this is a valid resistance level. Okay, pardon my not straight kind of line here. Okay, so we, without RSI, without Bollinger Bands, without moving averages, by purely looking at price action and plotting a support and resistance levels, this would have been an area, this level, okay, where I would have wanted to see some sort of testing and definite breaking above it before I place my long orders. Okay, I am seeing that the price action is rising to higher ground. Okay, RSI is confirming that the bulls are in control, but I need to see a valid confirmation in regards to price action before entering the position. Once we see this break above this key level, this support area, this resistance area that becomes support afterwards, my buy would have been somewhere in here. Okay, after we see the complete break above, okay, the breakout above prices, okay, this would have been an area of taking a long position here. Once we continue to see RSI staying above the 50, and then from there onwards making sharp movements, tracking the progress of the price action. Okay, so buy somewhere in here, and then where would have been the very nice place for you to close your position? Obviously, from pure price action, this lovely pullback here, but if you remember the chart patterns we've done in the prior session, you would have recognized that this is what we call a pennant, or you can call it a flag, whatever you want to call it. Okay, so it's a continuation pattern. Okay, a rapid acceleration of price action. You would reasonably expect to see some sort of pullback on the opposite direction. In this kind of case, what we're looking at here is it's obviously a bullish pennant, okay, or a flag. I can distinguish exactly what it is from here, but this serves as a valid signal that the price action is going to continue to move to high ground after it breaks this kind of level. It has indeed happened. So if you have bought here and you want to cover your position, things that you will look for are the break below, or at least the moving of the RSI indicator from overbought territory back within the bounce. So has reached an extreme level. What is this? Something like 85 or 90, certainly an extreme level. If you see these kind of moves, these sharp moves towards one direction, be skeptical and expect some sort of pullback, even though it's in its favor, in its bull's favor, that the price action will continue to soar to high ground, even only if they maintain this kind of momentum. So at the same time, you have to be skeptical, however, and plot where your exit would have been, and a lovely signal would have been generated here when you would have seen the RSI returning from extreme overbought conditions back towards the 70 level, okay, would have been an exit somewhere in there, okay? And once you saw bank, close the position and make money. And if you are primarily predisposed to keep playing this kind of instrument, okay, your confirmation for entering the picture would have been at the same level once you saw this breakdown, this this breakout above this level, okay? Because at that point in time, you saw the price action stalling, okay? So that now acts as a resistance. Once you see this clear break above that prior pick, would have been your entry point once again. So buy. And you would have confirmed that with, give me one sec, Hopefully it's going to be a straight line downwards. No, it's not going to be no bloody chance. Somewhere in here, the fact that the RSI, okay, rebounded once again from the 70 threshold. It did not come below that, okay? It rebounded from it. Super, super strong signal that price action is going to continue moving north, okay? So your entry point from a technical point of view could have been this, and you would have awaited for the same kind of scenario to once again materialize. This kind of case here, it's an area where you might have exited, okay? Or, and you can clearly see that it coincides with and break below the 70 level, but once again, found support, okay? In this is an extreme scenario with dollar yen over the past, this was somewhere in the 2019, 2020, 21, something like this, okay? Which we saw central banks rapidly increasing interest rates in order to tame inflationary pressures. For example, in this kind of cases, dollar yen. So we're talking about the Fed has indeed embarked on an aggressive tightening campaign, pushed interest rates to high ground. That leads to strength of the United States dollar compared to the weakness of the Japanese yen, because the Bank of Japan did nothing to address the inflationary problem. So this discrepancy between interest rates created this underlying kind of situations that benefited strongly the dollar at the expense of the yen. Okay, so you have to keep an eye on what's going on the wider economic scene, if you would like to get extra confirmation. So this is fundamental analysis in a sense. It's not technical analysis. So understanding how the whole international financial markets are working according to incoming data gives you much more, at least you make much more informed kind of choices in regards to your trading strategy or journey, or whatever that is. Okay, so if, for example, back in 2020, when was this? This is way too zoomed out. 2021 or 2022? Is it 2022? Yeah. So in this kind of period is where we have seen many central banks, much like the Federal Reserve, raising interest rates rapidly, okay, creating this discrepancy between net interest differential between other central banks, more specifically the Bank of Japan. So looking at this pair and studying what had been going on from a fundamental point of view, the buy signal was a definite kind of play here. No short selling this whatsoever, because once again, if the central bank of the United States, the Federal Reserve, raises interest rates in order to tame inflation, while at the same time the Bank of Japan, okay, does nothing, okay, certainly super beneficial for the dollar, and it's going to capitalize on the weakness of the yen. So if you understand this, okay, dynamic, okay, this is one aspect of fundamental analysis, how central banks behave, central banks' monetary policy practices, how they behave, how they affect, in a sense, foreign exchange kind of markets and currency pairs. You can use that alongside with technical analysis and make much more informed kind of decisions. Okay, so this is what we will be going over the next session. We're going to go into fundamental analysis, and primarily we're going to be discussing some the most widely known and used, not used, but widely studied economic indicators that affect the relationships of currencies, much like the dollar with the Japanese yen, or the euro with the British pound, or whatever that is. So we're going to be studying this kind of economic indicators that affect this kind of movements. So please feel free to join if you would like to get a glimpse of how you can approach trading, okay, not only with the technical knowledge, but with also fundamentals. So combining the two together is definitely giving you higher odds of placing a correct trade, okay? So this is what we will be doing in the next session. Obviously, it's going to be an overview of what kind of economic indicators you shall look at the ones that are actually yielding the most, that are actually having the most impact or the harshest impact on currency exchange rates, or in many other markets as well, much like, for example, in precious metals or commodities in general, or equities. Okay, it's all interconnected. We will discuss how this kind of impacts. Okay, so if you do not remember what fundamental analysis is all about, we have done in the past a session outlining, or is in a sense a brief introduction into fundamental analysis, outlaying what kind of events we are looking at and making much more informed choices. You can actually go and watch that at your own time, and obviously join next webinar to go in a much more deeper kind of level of understanding. Okay, so we are way past our time, guys. I think we have to end it here. We have covered RSI and all of that stuff. We have covered moving averages. We covered Bollinger Bands and RSI super briefly. We're gonna do them once again in future webinars. For the time being, we have to go. I have to go because I have some other tasks I need to do. Thank you for being here. If you have any sort of questions, please send them through. We have an email, okay? Webinars@t4trade.com, okay? You can send me an email there to have solve you any sort of queries you may have. If not, please study, please do your homework, and stay safe out there for the time being. Thanks for watching, and we'll catch you next week for another webinar. Take care. Bye-bye.